This is Booking It to Financial Freedom, show number 11.
We can get so just obsessed with watching our money grow, which can be very fun. But then if you're too obsessed with watching it day to day, then you're tempted to make tweaks to it, to increase it. But the point is to set it and forget it. And then it's that security blanket. It's your future self thanking you for what you did now.
You can get wealthy two different ways. Spend less and invest more, or basically make more money.
Stop worrying so much about the tax that you're paying. Like, some people will complain that they don't want to make more money because they don't want to pay more taxes.
You get a raise and it goes up $20,000 a year. Well, if that $20,000 falls in the highest tax bracket, that's the only
Yes.
that $20,000 gets taxed.
Welcome to Booking It to Financial Freedom, where we explore literature from some of the most successful experts in their field to help you build a blueprint for personal growth and financial freedom. Join us as we examine a new book every month and break down key concepts to help you get out of the rat race and on track to start building a life better than you ever imagined.
Hey everyone, I'm your host, Amanda Schneider, realtor and investor, and I'm here with my co-host and teammate, Jamie Booth. Hey Jamie.
Hey Amanda, how you doing?
Good, how are you?
I'm great. Weather changed a little bit today,
Yeah.
so I'm not too thrilled about that.
It was 60 degrees yesterday.
It was beautiful yesterday, and I had fully intended to hit the trail, and my day just went sideways, and
Yeah.
I am kind of disappointed I missed my opportunity, and then today it's horrible. And, we had planned to do the incline this weekend, and I don't
Right.
think the weather's going to hold
No.
it for that either.
I don't think so. Yeah, we were going to do the A team does the incline. Come join us. And for those of you that aren't familiar with the incline, it's basically a really steep climb with railroad ties. I think they used it back in the day to transport things up to Pikes Peak, I believe is what it was originally intended for.
Yeah.
Yeah.
And it's pretty tough. We were talking about doing more things as a team together, build that camaraderie, all that good stuff.
Yeah.
And if, for people who don't know, the incline, it's a pretty famous thing around Colorado Springs. A lot of athletes use it to train. That stuff is like over 2,700 steps, a couple thousand feet of elevation gain. It's pretty much straight up.
Yeah. It's not for the faint of heart. And
No.
if you come from sea level, it takes a couple weeks to attempt to do that.
Yeah, if you go online, they even have like a guide on how to tackle, strategies to tackle it, and ways to get up, exit strategies
Yeah.
and all this other stuff. It's pretty crazy, but it's a good workout.
When Lindsay first got here, he was coming from, I guess, Fort Bragg, which is sea level.
Yeah.
And he said that he thought if he just did the incline every day, it would help him
Acclimate faster.
sooner. Yeah. And instead he just pretty much put himself in the hospital almost because he was trying to do it every day, and it was terrible. So
Yes,
not a
and
good
it's
idea.
crazy because there are, there's record holders for doing it 5 times a day for a
Yes.
year straight. There's some people who take it overboard.
Yeah, well, and it's very humbling because, you and I are in pretty good shape. I can typically do it, I don't know, between 40 to 50 minutes-ish up. And you see all these older people passing you just up, and they're coming down and you're still going up. But they do it every day.
That actually reminds me of hiking in Korea, because you're out there climbing these big mountains, and all these little old Koreans in their hiking groups are just zipping up the side of the mountain.
That's funny. That's awesome. Are you doing anything for St. Patrick's Day?
No, we're not really going to go out. Probably just going to stay at the house and I'll cook some Irish food and drink Guinness, of course, but other than that, that's about it.
That's awesome. Yeah.
How about you?
I don't have any plans. Lindsay's actually leaving Friday to go to Florida for a few days. So I don't think I told you this, but we have new clients coming into town, and it's a guy and his wife. They're coming from the Q course, which is the Special Forces course, being stationed here, and they're actually going to stay in my basement while Lindsay's gone because we haven't found him a house yet, and so they just need some lodging for a couple days until they find something a little bit more permanent. And I was like, well, I have an open basement, so
There you
come
go.
on
It
in.
works out.
Yeah, so that's cool. But so today we're going to kind of touch on the last few chapters of I Will Teach You to Be Rich. And some of the big things is really just how to start. He's kind of built a lot of it up, and now it's how do you start it, automate it, and keep it going.
Yeah, at this point in the book, you should have all the kind of the basic financial foundations laid, and now it's time to kind of jump into
Yes.
putting your money to work for you.
So one of his chapters, he calls it Investing Isn't Only for the Rich. And so obviously we know that he's a big proponent of investing in the real estate market.
Yeah.
So that's kind of what this whole chapter is about.
Not in the real estate market.
Oh gosh, in the stock market.
In the stock market, yeah.
Yeah. So that's kind of what this whole chapter is about, just how to automate your investing, what his recommendations are, etc. He's a big fan, and we talked about this last time, of really doing a lot of it yourself, finding some low-cost index funds that you can invest into. And take this, kind of what we're explaining to you with a grain of salt. Neither Jamie nor I invest heavily in the stock market. We've got some retirement plans, etc. But from what I understand, the index funds are basically a bunch of stocks put together that, instead of investing in one stock and basically putting all your eggs in one basket, and if that stock does poorly, then you've lost all of your money. These index funds are really controlled by computers to try to match the returns of the market. And so it's a much safer way to invest.
Yeah, you're basically investing in the entire stock market, in the entire, like the S&P 500,
Right.
500 of the top producing companies. So it's a diversified portfolio as opposed to picking specific stocks. He goes into the book, he talks about how, you could pick a couple stocks that are like home runs that could, would it be the equivalent of picking Amazon stock back in the early days? I think he actually did himself.
Yeah.
He made a couple $100,000
Right.
off it. So, but it's even the most experienced stock, guys who do it for a living as far as picking, they fail more often than they succeed. So it's a much safer way to invest your money.
It is, because you're investing for the long term. And he even says, even though obviously I'm sure he's grateful that he picked Amazon back in the day, because it just happened to work out. He had picked several other stocks around that time too that did absolutely nothing. And he said if he would have known what he knows now, he would have never done that kind of investing because there was the potential to lose everything.
Even though he hit the home run with Amazon.
Yep.
Absolutely.
And he really talks about this crossover point to when you have really dialed in your investing, or as far as your savings and your automatic plan where your money's going to your savings and your investing, and your investments over the long term start to generate more than your salary. So he calls that the crossover point. And that's basically known as being financially independent. So if, some of our listeners also listen to some of the other, bigger pockets, what's the one you listen to?
Choose 5.
Choose 5.
Yeah.
That's what it is.
It's a really good one. And I like the fact that he brought up the FIRE community. It's an entire community. Once you get into it, like I said, there's entire podcasts, books. It's people, go out there. It's a real tight community as far as how they strategize to do the retire early and all that good stuff. So it's really good stuff if you start looking into it, if that's your kind of thing.
I think it helps. It kind of aligns with your why. It really helps you with goal setting, because so FI stands for financial independence, if we didn't make that clear. And so there's really kind of different levels you can achieve. So that financial independence, again, is when your investments or your passive income is paying for your daily living. But then you can combine that with what's called FIRE. So it's financially independent and retiring early. So instead of waiting until the standard like 65 to retire, maybe you can retire at 50 or earlier, etc. So, I would say Lindsay and I are the FIRE. Like, we want to hopefully achieve that in 5 to 6 years, or we don't.
I don't know who wouldn't want to be there, really.
Right?
So the whole point with FIRE is, eliminating all your debt, getting your investments working for you, and being able to live within your means for the rest of your life if you want to. And then he also mentions the difference between lean FIRE and fat FIRE. Well, lean FIRE is basically living a modestly basic lifestyle. So basically the goal is to retire as early as possible and basically be in cruise control at that point. So the lean FIRE, sensible home, all your debt paid off. And at that point, it lowers the threshold as far as being able to retire early. So a lot of people in the FIRE community are retiring like in their early 30s, like mid 30s and all that stuff. And then you have fat FIRE as well, which is basically, and there's a couple different mentality as far as the FIRE community goes. I would say the majority of FIRE folks are completely debt adverse. They don't want any debt whatsoever. Probably the fat FIRE people, those are the ones who are trying to live a more lavish lifestyle, who are investing, so are doing the more of the Robert Kiyosaki good debt, bad debt kind of stuff,
leveraging.
right? Leveraging their money and creating wealth.
Right, and they, the lean FIRE, and you correct me if I'm wrong, because you know this a little bit better than I, but it's really about cutting your expenses. So it's maybe living a bit of a more modest lifestyle, like you said. But then the fat fire is like, if you want to have the money to travel and buy the expensive
Right.
toys, that kind of stuff. So I would say ultimately our goal is fat fire. We'll take lean fire in the beginning, but I'd like to get to fat fire.
Yeah, it's just I mean, for me, it'd be just my take on it is that it's just a matter of knowing in the back of your mind that if you didn't want to work for the rest of your life at that
Right,
point,
you
you
don't
could.
have to.
You don't have to. But if you want more, then you start to achieve fat fire.
Right. One point he puts in this book, which I think is great because I hadn't really thought about it, is that a lot of people in the fire community, sometimes they get so obsessed with achieving that fire that they are making a lot of sacrifices to get there. So for 5 years, they're never traveling, they're never eating out, things like that, just so they can achieve this. And he said, you really have to understand why you're doing it. If you're fine with living that way, it's one thing, but if you feel like you're just giving up a lot of sacrifices and not truly enjoying life, then maybe reassess that too. Like, yeah, it'd be awesome to say you were retired by the time you were 35, but if you could extend that out another 5-10 years and actually enjoy your life and take some trips and stuff, maybe that's.
Well, I mean, I could sell my house right now, sell my Jeep, and go buy a really nice tent, and I could live for the rest of my life. I probably won't be very comfortable though, right?
Right, and you could be fired.
Yeah, I could be fired, lean fire.
Yeah, that's funny. And then kind of shifting to into the advice he gives with investments is knowing that your investment plan is more important than your actual investments itself. So again, investing in those index funds and things, and then basically setting and forgetting. And he was saying that, especially with index funds, really you only have to give it a couple hours of thought every year. And basically every year you just kind of adjust the percentages, because as some stocks do really well and some do not do well, etc. Maybe a portion of your money has kind of increased in certain areas, and you want to make sure that that's a little bit more equal. So I don't remember the term he uses, but it's basically just readjusting those percentages and making sure that everything is allocated how you want. So you do that every year and just kind of reallocate. But other than that, you literally set it and forget it. And making sure that you're diversifying. So,
I think that's probably the most attractive thing to just index funds. You don't have to worry about it. You just
I agree.
set a certain percentage of your paycheck to go to your index fund and you're good.
Right? Yeah. Unless you're someone who really likes it. I actually just met with a friend before we recorded this, and her husband works full time. He's a dental surgeon, but in his free time, he loves researching the stock market, and he's a day trader, and he loves that. But for the majority of us who maybe don't have the time or the desire to look into a lot of that stuff, finding these index funds, using some of the advice that Ramit puts in the book, just invest in those, set it and forget it.
Yeah, and so on the opposite side of the index fund is the plan that you were talking about. He has basically a diverse, how you would diversify your money into different aspects, he was talking about domestic commodities, overseas stuff, like a certain percentage will go into overseas investments, certain percentage will go into REITs, all that good stuff. And then basically he said if one portion of that portfolio, if you want to call it, maybe for lack of better terms, starts to outgrow the other one, then you would kind of shut that off. And then because he has a whole percentage base, like each
pie chart,
a certain percentage of your overall investments should be in one portion. If one side starts to outgrow the other, to keep it diversified, you basically would start shutting down investing into that portion and putting more money in the other ones until it all balances back out.
Right. Yeah. Yeah, that makes sense.
That's something else I was going to say and it slipped my mind.
Yeah. An even easier way he talks about in the book is to invest in target date funds. So those are truly set it and forget it. You never have to kind of readjust those percentages, because they literally take in, and I'm pretty sure this is what my IRA did or my 401k when I was at my W-2, because they asked for my age and retirement age and stuff. And then they pick the funds for you and they adjust it as you get older. Maybe, it's more aggressive in the beginning. And then as you get older, closer to retirement, it's much more conservative. But this target date funds do it for you. You don't even have to worry about it. So if you're a really lazy person, which is fine, just do that.
But and the other thing with the target date funds is they're more diversified. It's not just the S&P 500. They actually diversify the money into real estate, stocks, all that good stuff. So it's a little more robust as far as how they invest it.
Yeah.
The one thing, that's what I was going to say about the manual side of the investment, instead of just investing into the index funds. He said he was going to leave 10% of his diversified portfolio 10% of that money would be into picking. He called it like his fun money or whatever.
Yeah. Okay.
So that would be the portion of that pie chart that he would pick stocks with and play. So if you if you hit an Amazon, yay, you hit a home run. If you lose and you pick a company that completely tanks, then you're fine.
But you're limiting yourself. That makes sense. And he talks about the rule of 72, which I thought was really interesting, where basically you can divide 72 by the expected rate of return, which for the stock market is about 8%. And that gives you the number of years that it takes to double your investment. Yeah. So I thought that was really interesting because it's like if you have $10,000 and it earns 8%, X number of years it will double.
Yeah, and basically I think at 8% would be around 12 years it would double.
It takes a little bit.
You want around a 10% return to double your money in 7 years. Mm-hmm. So obviously, if you have a higher rate of return, like a 14% rate of return, your money's going to double faster than if it were a 10 or 8% return. Right. Yeah, I've known about this for a long time. It's just one of those things that like you don't pay attention to unless you're really into growing your wealth through stocks. But it's pretty exciting actually because if that the stock market averages 8%. So you throw in $30,000 if you have it, in about 12 years, that's going to be $60,000. Mm-hmm. So,
because I assume that calculation takes the compounding effect into consideration. So, cool. But if our listeners, hopefully you're reading the book too, but if you do want some more detailed explanation of how to get into the index funds or even picking your own stocks because you are interested in it, he does have a whole section in the book and he calls it the Swenson model, which is what you were talking about, the different like overseas investments, the real estate, etc., and kind of a recommendation of how much to put in each. Something I thought was interesting is he doesn't have, or that recommendation on that model, you don't have 20%, more than 20% in any portion, and that's the diversification.
Yeah, the built-in diversification with the model.
Yeah. You're safeguarding yourself. And then he talks about stocks and bonds, and I just kind of wanted to chat about that real quick just to kind of, make sure our listeners understand. So bonds are a super secure form of investing. It's either backed by the government or companies. Your rate of return is way lower. You're not going to get that 8%. But as you get older, it's good to have a mix of stocks and bonds in your portfolio to help safeguard. Yep. He gave the example of Oprah. And now I think I'm making these numbers up, but I think she bought like a $8 million house or something. And he was saying, basically because she is worth billions, she could take, 500 million, invest it in some bonds, even at the low rate of return that they get, which is probably 2 or 3%, and have paid her house off.
It paid for the house.
It paid for the house because, the more money you have, then it makes sense because even at that low interest rate, that compounding effect is going to make you that money and it's safer. Bonds, so.
Yeah, he used another example. I think it was a comedian or something that heavily invested in bonds, but, someone had asked him why, and he's like, that's not very much. And he's like, yeah, when you have like millions and millions of them, right? The money does pay off. And the other thing the point he was making with bonds is, and you kind of touched on it there, is once you've won the game, so once your investments are so big that they're producing so much money that you can live off of it, and you get older, you've basically won the game at that point. So it's all about keeping your money as opposed to losing it. So that's why the bonds become so much more attractive, specifically the older you get. So if you're close to retirement age and you have all of your money in the stock market, you want to protect that. So you put it in a more guaranteed vehicle that's going to continue to make you money without losing any of it.
So
and
the goal
the rich do the same thing. Once they have hundreds of millions of dollars that they've generated, or billions in the case of Oprah, how much more money do you really need at that point? So you just want to keep it. So put it in bonds.
So the goal is for all of us to get to the point where it makes sense for us to invest in bonds.
Absolutely.
So then the next chapter after is basically he's just talking about how to maintain and grow your systems. So an important point he makes is make sure that you're living outside of your spreadsheet, because we can get so just obsessed with watching our money grow, which can be very fun. But then if you're too obsessed with watching it day to day, et cetera, then you're tempted to make tweaks to it, to increase it, et cetera, et cetera. But the point is...
Or live miserably.
Yes, exactly. Be like, oh, I spent too much on this. And yeah. But the point is to set it and forget it. And then it's that security blanket. It's your future self thanking you for what you did now.
Yeah. And then, the other thing I think it talks about reviewing it annually, and it should take you like 2 or 3. Once you get everything going and you're growing your system, you're living within his guilt-free spending system, all that stuff. Once it's all automated, it takes 2 or 3 hours a year to kind of tweak it a little bit, and then you just continue living your life.
Yes. Yeah. And something that's kind of neat too is I've noticed there's a theme, because I've started reading next month's book already too, but there's a theme in each of the books that we are reading where however they define it, everyone wants you to figure out what your why is. So just like Simon Sinek, it's important to understand your why. Ramit says the same thing of he really encourages readers to define their why and get specific of why you want to earn X amount of dollars and why your goals are your goals. Otherwise, you're eventually going to lose interest. You might be excited now, but eventually you're going to be like, I'm just going to take that money out and buy whatever. You're not going to want to leave it in there. So really making sure that you're defining that why. And with every book we're reading this year, I think that's going to be a theme throughout, is you really have to understand your why.
Yeah, understanding your why and paying yourself first probably is going to continue to reoccur.
Yeah, I think we should read Profit. I don't think we have Profit first in this year's lineup. We'll have to do it next year, but that's the same theme as just like making sure you pay yourself first, which is so important.
And we don't have Richest Man in Babylon on the list either, do we?
I don't think so.
But that's pretty much the entire theme of that book. Yeah.
Yeah.
And we'll get to it next year, maybe.
Yeah, for sure. So basically the action steps, for growing your system is you have to start with that conscious spending plan like we talked about last time, and understanding where your spending's going, what's going to make you happy as far as, I'm saving this, I'm investing this, and I've still got this left over because these, travel or whatever it is the most important thing for me. So I still have money left over, but I'm still being a responsible adult, helping my future self. So that conscious spending plan, and then increasing as you can. If you want to level up and get there sooner, then you probably have to start investing even more money. So if you can, is there anything you can cut back on and put that money towards investing, and you'll just get to where you want to be that much sooner.
Or making more money.
Yeah.
I like that point. I think that's one of the aspects of the conscious spending plan or any kind of financial plan that anybody would have to grow their wealth. I think that's the part that excites me. And I think we talked about it in the prior episodes. Is like, you get your 30% of whatever your take home pay is now, 30-40%, whatever it is, that's your guilt-free spending money. But the exciting point is growing that, so it'll always remain, it should always remain 30-40% of your your total conscious spending plan. But the exciting part is making that 30% grow exponentially over the years by sticking with your financial plan and growing your wealth.
Yes.
So I think that's really fun. And he talks about that in this chapter too, about, you can get wealthy 2 different ways: spend less and invest more, or basically make more money, which is what I'm trying to do.
Exactly.
With my business. I'm trying to grow it exponentially. So my little 30%, 40% pool gets a lot bigger here in the near future, hopefully. So
yeah, and he gives I'm not sure if it's this chapter or the other, but he gives actual scripts that you can use to ask for a raise if you're a W-2 employee. And if, when I was a W-2, it wouldn't, I worked for such a big company that it's you just have to wait for your annual 1% raise or whatever. Yeah. But you can hustle. You can do side gigs, to earn more money. So there's always ways that you can increase your income.
Yeah. Start side businesses.
Yeah, for sure.
Buy an investment property.
Yeah. If you need a realtor, I know one. Okay. He talks about taxes, which we've touched on taxes, I think, with Robert Kiyosaki's book. But basically, he says, stop worrying so much about the tax that you're paying. Some people will complain that they don't want to make more money because they don't want to pay more taxes. And this chapter definitely gave me a chuckle because he's pretty straightforward about it.
Oh yeah.
Just stop worrying about it. Yeah, don't be stupid. Because He's just saying, and we're all guilty of it, of maybe repeating something we've heard from somebody else, but not actually doing the research ourselves and assuming we know how taxes work. One major point he makes in there, which is really important, especially as you maybe go up in income tax bracket, is marginal
tax brackets.
Yeah. So if your income pushes you to the next level, you aren't paying. So say you're now, the top of your income is in the 30% tax bracket. Say you actually only pay, it's chunks. So say, I'm making this up, but 10 to 50,000 is taxed at 10%. Your first 50,000 is taxed at 10%.
Yep.
And then the next, 50 to 100 is taxed at the next tax bracket, et cetera. And this is all your taxable income. So, again, with us owning our own business, having real estate investments, there's a lot we can write off. So our taxable income significantly decreases,
Yep.
which helps to move us in a lower tax bracket. But you are only paying that high percent on the last portion.
Yeah, just say you're a high income earner and you get a raise and it goes up $20,000 a year.
Mm-hmm.
Well, if that $20,000 falls in the highest tax bracket, that's the only
Yes.
that $20,000 gets taxed.
Mm-hmm.
He tells a story of a guy who for years refused to accept a raise from his company
Insane.
because he thought if he made any more money, he'd be in the next tax bracket and he would actually lose income.
Mm-hmm.
Completely ignorant to the fact of how marginal tax bracket works.
Right. Yeah.
So crazy.
Important to do your research. Ask, your tax professional if you need someone to explain it to you, but it's very crazy. Some things you can do though, if you are worried about taxes is, 401ks and Roth IRAs are great ways to save on taxes. So 401ks are typically, because it's typically a traditional, is it's not taxed until you withdraw.
Yeah, it's called a tax advantage account.
Yes. So the point of that is that probably when you get to 59 and a half and you can withdraw, you're probably going to be in a lower tax bracket because you're probably not working as much, et cetera, earning as much. So your tax bracket will be lower. And so you're paying less tax. Or if you invest in a Roth and pay taxes now, that money actually grows completely tax free. And so when you withdraw, you're not paying taxes because you've already paid taxes on the money that you're investing.
Basically with the Roth IRA, you're betting on the fact that future tax rates are going to be higher than today's, which they almost certainly are.
Yeah.
So if you pay the taxes at today's rate, in 20, 30 years or 40 years, whenever you start pulling that money out of that Roth, you've already paid taxes at today's rate. And you're not taxed again in the future at a higher rate.
Exactly.
Yeah.
And if you're not really sure which one is good for you, you can diversify again. You can have an IRA that's a Roth and you can have a 401k that's a traditional, something that uses both strategies. And so that way you're kind of in the middle. Yeah.
He uses an example in the book of someone he knew who had like 3 or 4 different retirement accounts. So by all means.
Something you do have to be aware of though, in investing, and this is kind of outside of retirement accounts, because again, those need to sit in there and grow for 59 and a half or until you're 59 and a half. And you're not, when you pull those out and stuff, you're not paying capital gains. But if you are actually just investing in the stock market and you're selling shares, you have to understand capital gains. I think he said that he has never sold a stock other than, like Amazon, I guess he's profited on, but he had said that he does not, it's super rare for him to sell anything. He just invests.
He definitely advises against it.
Yeah. So you just have to understand that if you would sell a stock within the first year, you're paying short-term capital gains, which is taxed basically at your income rate, at your highest income rate. But if you hold it at least for a year or more, now it's long-term capital gains, which is a much lower rate. It's calculated on your tax rate, but it's much lower. But basically, he advises don't sell. The point is you're in there for the long term. If the stock market goes down, you ride that wave. You can buy more of that stock cheaper, and then you just wait till it comes up. That's
the important thing. Don't empty or cash out your retirement fund just because you think that stock market's crashing or whatever. It will come back.
Yeah.
It's if you look at the last 100 years, it continues to grow no matter what. So. Just got to kind of ride it out. Yeah.
And if you're somebody that can't deal with that, then maybe the stock market isn't for you, because it certainly will go down. It always does.
Yeah.
So you and I were talking before we started recording, is we just want to make sure that our listeners understand other options to invest as well. Obviously, this book is very heavy into the stock market because that's what has worked for him and what he is very knowledgeable on. Obviously, you and I are big fans of real estate. I think it's great to diversify and invest in a few different things, but I just want to make sure that our listeners understand some other things you can do with investing, especially if the stock market makes you feel uncomfortable. Maybe you want to try some investments that can get you a little bit higher returns than just that standard 8%. And again, obviously real estate is one of our preferred investments. So I just wanted to give you guys kind of an example of something that Lindsay and I have done and what our returns look like. So this last year we spent about $200,000 building an addition onto our house. So it's a little mother-in-law suite. It's a 1-bed, 1-bath, full kitchen, laundry, everything. And we Airbnb that unit. So it was, like I said, about $200K to build it and to furnish it. I mean, probably $15,000 of furnishing. But we started renting it in May of last year. So this is just in the first 6 months. Our net income after, paying cleaners and things like that for Airbnb was $27,500. So if you do the math, it actually turns out to be a 14% return on investment in just the first 6 months. So I personally feel like real estate is a pretty safe investment. And the reason I feel that way is because with the stock market, when you're investing, you put your money into the stock market and you could lose all of it. When I'm investing in real estate, I still always have an asset. Maybe that asset is worth less because the real estate market crashed, like 2007, etc. But there are things I can do to kind of hedge against that. I can turn it into a rental, Airbnb. I can live in it and rent out my basement. Like there's a lot of things I can do to kind of mitigate those years of maybe some type of crash, but I've always got that asset that's always going to be worth something. Mm-hmm. So for me, that's a lot safer investment.
Well, the real estate market is the same as the stock market. Mm-hmm. It continues to grow. Again, you look at the last 100 years, perfect example, my mother-in-law, she bought a house, I think in the early 70s. Mm-hmm. There's been multiple housing, crashes in that time period up to now. Mm-hmm. And she's about to sell that house for $450,000. So tell me that, in the long run, real estate is not a sound investment.
Right.
I mean, obviously your returns are going to highly depend on the area that you buy in. Colorado Springs is going to be completely different than if you buy it in some small rural, county out in Ohio. Right. It's all going to be different. But at the end of the day, those prices will almost certainly go up. Mm-hmm. So I just don't understand the argument against real estate. Obviously, you want to diversify. You want to be in the stock market. You want to be in real estate. You want to have. He even talks about investing in art in the book as well. I don't know if you caught that one. Yeah. But again, it's like picking stocks. Like he said. Was the example he used for investing in art. The guy had bought 100 and some odd pieces of art, mm-hmm. and only 2 pieces out of the 100 plus actually made it profitable. Yeah. So investing in anything is risky. Yeah. So it's all about diversification. Right.
Yeah, for sure. And, I just want to make a couple more points on the real estate too, is like when I'm giving these numbers, we haven't even factored in appreciation, and obviously that ebbs and flows, but the standard is that over the years, an average is about 3%. I mean, last year we had like 12 to 14% here in Colorado Springs. So just like with the stock market, you can't necessarily time that, but you can do things to kind of hold through times that are lower, etc. And we'll go into more detail in the next episode about what it looks like to own your primary residence and some things you should consider. If real estate isn't like you aren't buying an investment property and having people rent it, but it's your primary, some things you should consider there to make sure you're not spending above your means, etc. But overall, big fans. And the one last thing too I want to say about real estate is what I love about it is the power of leverage, because you can use a loan. So obviously, again, and I'm not bashing the stock market, but just comparing it apples to apples. I can buy a $500,000 house. I only have to put down, 20%, 25% of that. And then the rest is leveraged through a loan. And yes, that's added to my debt, but I now have a $500,000 asset that is generating income based off of $500,000. And I didn't have that $500,000 cash. So absolutely. That's pretty cool.
Very powerful.
It is. And then just a couple other things too. You can be, if you do have some extra cash, $50,000, $100,000, you can be a private lender for people. We use that a lot with our family. We've borrowed money from my mom after she sold her house. And she's in her 60s. She doesn't want to invest this in the stock market because that's scary to her. But she knows with us, it's a guaranteed 8% return, because when we make our private loans, we actually in our contract says that if we default, she gets the house. So,
Right.
I mean, she's not losing anything.
She needs to be out there buying those bonds.
Right? She does. But she's making more on us than she is on the bonds.
Absolutely.
But that's something you can do, is get into private lending. And that is, especially if you know people in the real estate world, there's always a need for that. And then we've talked about, some of these require you to be an accredited investor, which is having so much wealth or making so much a year. But once you get to those points, you can do things like syndication, which is basically a group of people investing into a large real estate investment. So usually like a huge commercial space or like, a 100-unit apartment complex. But you're really like lessening your risk there. And it's, again, there's usually some type of guarantee, but I mean, those can produce anywhere from like 15 to 25%.
Yeah.
They are high returns. You typically get your money back in a couple of years.
Yeah, and this is the whole the rich get richer kind of thing. So anybody can get there, though.
Yep.
I mean, don't be discouraged by somebody who's an investor who's making a 25% return on a gold mine,
Right.
which you can do.
Yeah. And you can network and find those people, because if you know an accredited investor, maybe you can go in as a group. And you can, if you have 20,000, then you invest that 20,000 with them. And there's some syndications you don't have to be accredited. So there's all kinds of options out there. But I just wanted to make sure people understood that there are other options besides the stock market.
Yeah, he does lean very heavily on the stock market. I mean, he does touch a little bit. And of course, he does a lot of real estate bashing too. So, which we'll get into in the next episode. But there's if there's a will, there's a way. And I think we talked about this in several times in past episodes, is it's never, it doesn't matter what your situation is, you can start investing one way or another. You can find a way.
Yes.
It's all about finding your why and making it happen one way or the other.
Yeah. And what you're interested in too. I just have no real interest in the stock market. I love real estate, but maybe somebody else loves the idea of researching stocks. So that's your asset class then, is stocks.
Well, I mean, I think one of the reasons why he really leans heavily on the stock market is because you can do the index funds.
True.
You can do your 401ks or whatever. And it's kind of like, back to his spending plan. It's all about set it and forget it. So index fund, super easy, set it, get your match with your company if you're doing a 403b or whatever, all that good stuff, and just letting it go on autopilot.
Yeah, agreed.
Whereas real estate can be a lot more.
Yeah, you've
intense.
got it's a lot more involved, or you have to know people that can guide you for sure. So, cool. Well, I think that about wraps up this episode. You want to take us out?
Awesome. Yeah. So if you liked what you heard today, please support or help support and grow our podcast and YouTube channel by leaving us a rating and review. If you're watching this solely on YouTube, give us a like by hitting that thumbs up and hitting that bell to get notified when we have future videos released. And please subscribe to the channel. Let us know what you think by leaving a comment below.
Perfect. See you guys
Awesome.
next time.
Thanks, guys.